Hello and welcome to In Focus. I'm your host, Mike Klan. The stock market is in a financial freefall. We will talk with a financial planner on what we should do with our money. We will also hear from the president of Santa Barbara City College on issues such as cost, affordable housing, and a wave of construction that's coming to SBCC. We begin with the stock market turmoil. In Focus welcomes in certified financial planner Kevin Bourke. He is a registered principal with and offers securities through LPL Financial. Thank you so much for being here.
Thank you, Mike.
Just to get some perspective, how long have you had a career in the financial markets?
Well, I started in May of 1987, so a little over 21 years.
Wow. Yeah. So this is just a historic collapse, at least from when you've been working.
Yeah, that's true, although within a few months of when I started,
October,
we had October of 87,
right.
So it was a pretty tough time, too.
Right. And now, a year ago, almost a year ago, the Dow was at a record high of over 14,000. It's lost about 40%. Is it fair to classify this as a disaster?
It's a very difficult market, and people are having a pretty tough time, no question.
And in your opinion, what are the key factors that are bringing the markets down?
Well, of course, the credit crisis is at the bottom of all this. We're all familiar with the subprime mortgages that were given to people who obviously couldn't afford the houses, and now a lot of those people are underwater, so they owe more than the house is worth. And at the same time, their payments might have gone up because of having an adjustable rate mortgage. So that's kind of the bottom, at the base of all this problem.
And what about, what role does fear play into this?
Well, fear, it's a confidence game, right? That's what the stock market is. And so as fear sets in, people get nervous, they pull their money back, they get more and more scared about the future, and of course that's a cascade effect, and that's what we're seeing now.
Americans have lost over $2 trillion in retirement savings in the past 15 months. It's fair to say that some of these people will never get that back, depending on their age.
Well, hopefully they set their portfolios up in such a way that they have some sort of cushion or some sort of protection against the downside of the market. But yeah, if a person's older, this could be very, very difficult.
The federal government is trying a lot of things. Of course, the big bailout really hasn't been put into effect yet. They're trying to figure out how all that money is going to be. Interest rates go down. What, if anything else, do you think that the federal government could do?
Well, the main issue, again, as you mentioned earlier, is having confidence in the market. They are pulling out all the stops. We had that concerted effort worldwide where the G7 and some other nations all lowered interest rates 0.5%. Didn't help a whole lot. Yesterday, the government said they would take stakes in banks. Even that didn't help a whole lot. But the key is that they continue to step up to the plate, they continue to say they're committed, and they're taking actions to do that. So at some point, all that needs to kick in. At some point, there will be liquidity in the credit markets, and it will help. It may not be today, may not be next week, but it is going to kick in.
And are you okay with the government taking stakes into the banks?
Well, I would rather they didn't. I would rather they hadn't called this a bailout plan to begin with, because it sounds like it's the little guy helping out big corporations. Really, when the government did this with the S&L crisis back in the early 90s, Resolution Trust Company, they were able to buy assets cheap and sell them at a later date and actually make money in some cases. So I wish they had rephrased this a little bit and made it what it really is, which is let's help the American public get back on its feet. It's not just to help big corporations. When you read the fine print, really they're going to be able to purchase assets at a discount and hopefully sell them later at a profit. So just the verbiage of it, I wish had been a little bit different.
Right. I'm not going to ask your opinion on Mad Money's Jim Cramer, but recently he told his viewers, and he's almost always bullish on the market, to get out of stocks. And the stock market is going to be bad for 5 years. Do you agree with him?
Well, it really depends on your situation. At Bourke Wealth Management, I have clients calling in with varying degrees of concern, and I have some people calling in purchasing stocks. They see it as a buying opportunity. If you can afford to take the risk of waiting out a year or 2 or 3, or if he's right, even 5, then maybe it is a time to get in. Certainly people like Warren Buffett are stepping up to the plate, and he seems to have been a pretty successful investor over the years.
Yeah, that's true. Well, we're just getting started. We're going to have another segment up next. What ways, if any, can you protect your investment portfolio? We'll be right back. Certified financial planner Kevin Bourke is our guest. Kevin, if you've invested a pretty good deal of money into the stock market, what do you think people should do? I mean, obviously, I guess it depends on their situation, their age, and everything. But would you advise most people to stick it out?
Well, I have to go back to what you said about age and income and so forth. I had a young man call me yesterday. I say young, meaning in his 30s. And he wanted to get out of the market. It just didn't suit his risk profile, his risk tolerance. He was losing sleep, in which case he's probably doing the right thing. On the other hand, I have clients in their 90s, literally. They've been through things like this before. I mean, they lived through the Depression. And they're saying, you know, let's stick with it and see where this thing leads. But basically, if you believe in the health of the American economy long term, well, then maybe sticking with the stock market is the place to be.
What is the worst thing someone can do?
The worst thing someone can do, you know, it's like driving. I remember when I was in my early 20s, a rabbit ran out in front of the road. I almost killed everybody in the car trying to swerve to miss the rabbit. Then I decided better to kill the rabbit. In other words, don't panic. Don't panic. So that's really probably the worst thing people could do right now.
How are you holding up?
I'm doing okay. My clients are calling in and asking me how I'm doing. I appreciate that.
All right. Many people contribute to a 401k. Should they continue to put money, some of their paycheck into it?
Well, by definition, a 401k is long-term money. You can't access it till you're at retirement age. And so we're assuming they're working, so they're not retired yet. And they're also doing what's called dollar cost averaging, which means putting money in regularly, buying more when shares are low, buying less when shares are high. I would say since it's long-term, for most people, the answer would be to stick with the program.
And I read about rebalancing your 401k. What does that mean?
Rebalancing means you have a certain allocation, which is really an extremely important portion of investing. So much in stocks, so much in bonds, so much in cash. If stocks have done poorly and bonds have done well, then they get out of balance. So every year going back and saying, okay, I want this percentage in stocks, getting it back to that, and so forth in bonds. It's a very important process to go through on a regular basis.
Just, cold cash.
Cold cash? Well, it buys coffee. It feels pretty good at the moment. So depending again on your situation, some people are moving some monies into cash to have it in reserve, to put it back into the market at some point. Really depends on how much sleep are you kicking your dog? Are you yelling at your wife? And how are you taking all this?
Of course, if you take money out, you might miss the upswing.
That is the problem. And when it comes back, it tends to move fairly quickly for the first, for the first run.
Right. It's impossible to really pick a bottom. But what recovery time? What do you think? I mean, I know you don't have a crystal ball, but
right. Thank you. That's true. Well, again, typically, we see the market. The first movement is pretty fast. So let's say the market drops X percent, it'll recover some of that pretty quickly. The old adage about you lose 50% of your money, you have to make 100% back to be even, right? So it could take some time before this market gets back to where it was at 14,000. I'd say at least years. Above that, yeah, exactly.
A lot of panic going on. How do you keep cool? And your clients? I mean, how do you?
Well, I'm a long-term believer in, I'm glad I live in America. I'm a long-term believer in the American economy, ingenuity, innovation, and I'm in it for the long term.
All right. Well, we're going to put up some information on how you can contact Kevin. It's BourkeWealthManagement.com. Thank you so much for being here.
Thanks, Mike.
All right. With education price, right? And there's a lot of panic going on. How do you keep cool? And your clients? I mean, how do you?
Well, I'm a long-term believer in, I'm glad I live in America. I'm a long-term believer in the American economy, ingenuity, innovation, and I'm in it for the long term.
All right. Well, we're going to put up some information on how you can contact Kevin. It's BourkeWealthManagement.com. Thank you so much for being here.
Thanks, Mike.
All right. With education